Welcome, everybody, to the February market update featuring the expertise of the one and only Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide. Our distinguished speaker, Mike Ott, brings a wealth of experience to the table with a background as former public school teacher and an impressive digit tenor in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him to both clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update an indispensable resource for agents seeking to stay ahead of the curve, especially the way Mike does this with real detailed, up to the minute information, which I really like. Versus old stuff. So I really appreciate you doing that, Mike. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded and sought after trainer with us further underscores his expertise. Please join me in extending a warm welcome to our presenter for today, the one and only Mike Ott.
Thank you, Cindy. Thank you very much. Good afternoon, everybody. Welcome to the February monthly market update. And oh, those darn rates still stubborn. Let's look at our loan types. Conventional conforming, and the conforming limit now is 806,500. So when we're doing conventional financing and we're below that, we're in that conventional conforming bucket. 6.75 to 7.25 has been the range. That's down a little bit from our report last month, where we had a little more stubborn spike in the rates. Things have settled down somewhat. Obviously not as much as we would like, and our buyers and our potential sellers would like to see them at. But that's the range on the conforming. On the high balance, when you go above that 806,500, that span from 7 to 7.5 is where those are. Government products, VA loan 6.5 to 7. FHA and USDA 6.75 to 7.25. MortgageNewsDaily.com is the plug for kind of a free site that's out there. You don't need to be a member or pay a membership fee or anything to access that. They do a really good job of kind of tracking the national averages across the programs as well. All right, for those of you that been with us here, you know the mortgage-backed securities candlestick chart. If you're new, this is that kind of thing I have up on one screen, and I'm watching this all day like I'm a stockbroker or something. See what the mortgage-backed securities coupons are doing. We've been we had this down. You see the arrow down and the arrow back up, highlighted there by the CPI inflation data report that we got last week. We'll talk more details about that. That report didn't do us any favors, but we had 2 days that followed it that the market kind of recovered and, for lack of better terms, kind of shrugged off that not so great inflation reading. So we're kind of on an upward trend. You see today that far right candlestick there in the red. We're down a little bit from where we closed on last Friday. After, again, we had the holiday weekend, no activity yesterday. Got a little bit of boost on Friday with the retail sales that came in below expectations. So again, that's a sign that maybe the consumer is not spending as much on goods and services. Oh, and reminder to those that have been here, if you're new, and I'll go back. When we look at this chart, this is inverse to rates, right? So when the trend on this chart is down, right, the inverse is happening to interest rates. That means rates are going up. So we like to see an upward trend on this chart because the inverse is then that means interest rates to the consumers are getting better and improving and going lower. All right, market news. Since we last met, we had the December PCE inflation report that was at the last day of January. Headline PC inflation for November increased by 0.3 month over month and increased 0.2 to 2.6 year over year, in line with expectations. The core reading, which the Fed follows the closely. That's their favorite gauge of inflation. Increased by 0.2 month over month, remained flat at 2.8 year over year, in line with the estimates. So no damage done there, no improvement, but no damage done with that report. Then we jump into the month of January. We got ADP employment report. 183 jobs were created. That was stronger than the expectations of 150. So not not great news for the bond market and interest rates, but that one's not followed as closely as the BLS jobs report. But before we get to the BLS, we had the JOLTS job openings. Remember, this is the one where it's really hard to take this data at face value. When an employer posts a remote work position, they might be doing it in multiple states, and each time that job is counted in all the states as an additional job, when really the reality is it's just one job. Now, this was a lower reading. It's in green there, like our charts. We want to see green. Job openings decreased from a revised 8.156 million to 7.6 million, less than the 8 million expected. So came in less than expected. And again, that's I take that as a sign that maybe the job openings are starting to settle down as well. And then we got our BLS jobs report that was on February 7th. And, it showed that there was an increase of 143 jobs in the month of December, which was below the market expectations of 170. That news alone is good because it missed the job creation estimate. But the fact that the unemployment rate decreased 0.1%, going from 4.1 down to 4, kind of muted any celebration that the bond market might have had. And remember, you've heard me say that the Fed, we're set on cruise control right now. And for the Fed to continue their path to lower rates, we are going to have to see unemployment creep up. Now, we get over 200,000 initial jobless claims per week, and we've been getting that for quite some time. And you think, okay, well, if that's continuing to happen week after week, right, why are we not seeing this showing unemployment? Well, remember, the unemployment benefit ends at 6 weeks, and then these people are no longer counted in the number. And the word on the street is that, when these people lose their jobs, especially jobs in the private sector, they're finding it really hard to find another job. So again, I think this is still kind of brewing in the background. I think we're going to see an uptick in unemployment throughout this year, but this stuff is never linear, and it can, hop in and out. And there's obviously a lot of talk, from the government jobs position, and people being offered the deferred resignation or positions cut entirely. So I think we're going to start to see some of that take hold. And in future, in the next few months, we might see some of these numbers jump up a little bit. All right, CPI was just last week. That was kind of the, pull the rug out from under us day last week, where we had that long dropping red candlestick. At the core level, right, it increased 0.5 month over month, and that was above the expectations of 0.3. So, an increase of 0.1 to 3% year over year, higher than the estimates of 2.9. The core CPI rate, which strips out the food and energy, increased by 0.4 in January, above the expectations of 0.3, and increased 0.1 to 3.3 year over year, higher than the estimates of 3.1. So when that came out last week, I think it was Wednesday morning, the markets did not like that. That was not a initial favorable reading. And again, it just shows that, this stuff that goes into the model that we've kind of been battling has the lag effects like shelter. So I kept this slide in from last month when we looked at the December CPI. And I kind of want to point out in the shelter component, which is, arguably 46% of the reading, this lodging away from home was a negative number. And we had low rent and owner's equivalent rent. Used cars A little bit elevated. Airlines came in and were airline fares kind of hurt us on that in this report. Motor vehicle insurance at 0.4. Now, when you kind of take a snapshot of these numbers here, and when we look at what just came out last week, this lodging away from home, that's a huge swing from a negative number to 1.43. And keep in mind, this is the wild card in the shelter component. This is your hotel stays, your Airbnb and Verbo rentals. Um, and it's really hard to to predict this month to month. I don't know if this is like, hey, early January, it's the end of the holiday, the new year, where people traveling. A lot of people will, sometimes take their vacations and go to the warmer climates in January. So that could be the reason for that spike. But used cars and motor vehicle insurance didn't help either. Those were elevated readings for the month of January. And again, you've heard me gripe and complain about motor vehicle insurance. That one's tough because the Fed really can't touch that with economic policy. Um, and whether it's auto, this is motor vehicle insurance, but just from a housing industry perspective, we've seen increases in the homeowners insurance, and we're actually going to talk about that a little bit because that's now becoming a bigger and bigger factor of why borrowers are not qualifying for homes because the insurance costs, along with the elevated interest rates, have gone up so much. All right, local real estate. Northern Virginia area median price was 685. That was up 5.4% year over year. Total sales from a year ago were up 8%. Prince William area moved a little bit downward. That they think they were like 550,000 for median price, but it dropped to 505, down 1% year over year. Total sales in January down from a year ago, down much, much more at negative 13.4%. Dulles area, these are December's numbers. Again, they don't I'm not sure. They must wait till the end of the month to publish the previous month's numbers. But they're at 736, 267. They were up 9.9 year over year on median price. Total sales from a year ago up 29.4%. That was a huge December for Loudoun County on a year over year look. Or I should say, it's predominantly Loudoun County. All right, so more news came out in January, and maybe you've seen this. I've seen it locally, and in and around my neighborhood here, zip code and parts of this county where we definitely have some more inventory on the market. And this Redfin report came out and shows that housing supply rose the highest level since January 2020. But at the same time, demand fell to the lowest level since 2020 as mortgage rates are obviously hitting an 8th-month high here in the current state. Yet sellers are making moves because they're tired of waiting for mortgage rates to fall. That was something that my mentor had said. When I came into the industry, we were arguably sixes, mid sixes, low sevens. So I'm not, uh, too jaded by what I see now because I kind of entered the industry at that time. Then yes, was spoiled with the low rates up until after COVID, and this inflation bug that we've got. But my mentor said, if the rates stay elevated long enough, people just get used to it, right? And then they'll move forward with their plans to move. And I think that's probably what's happening with some of the inventory that's coming on the market. Problem is, they're sitting a little bit longer. And again, this isn't everywhere. Real estate's so local. You guys know that. But the homes that are sitting, a lot of it is due, on a national level and then in some local markets where the prices are still too high. And you've got these buyers that are, skittish amid economic uncertainty. I've got three prospect clients right now that are federal government employees that have kind of just hit the pause button, and all three of them are like, I can't do this right now because I don't know if I'm going to have a job. So there's a lot of that going on, a lot of uncertainty. But in the background, there's still more demand than there is supply, and prices, on a national average up 4% from last year. Typical home that sold sat on the market for 56 days, the longest of any January since 2020. I don't know what you guys are seeing in, your neck of the woods, but I do see some inventory coming to the market, in my area and the areas that I service. Um, but I also see in some of these areas, I still see bid over ask and, multiple offers. So it truly is a local event for sure. This was interesting. I don't know if you guys caught this when Fed Chair Powell spoke last week, either the 2 days. I think he talks to the Senate Banking Committee, and this idea of mortgage desert. Fed chair warns high-risk states could become mortgage deserts in as little as 10 years, making home ownership impossible. Um, did any of you catch this or hear this, or do you know what he's referring to here? And this, I've mentioned the cost of homeowners insurance. This is uh, focusing on places like California with the wildfires, Florida, your states that are on the Gulf Coast that, are getting uh, repeatedly hindered by hurricanes. You've got insurance companies pulling out of these states, canceling people's policies that, he he testified and said, it wouldn't be surprising if there's certain areas in the country where people can't get mortgage financing. And he went on to say it's not just the insurers pulling out. And there's the backdrop, right? Well, if State Farm leaves Florida, for example, right? Well, yes, there's other carriers there still, but your default is you have state insurance. Now, that's going to be much pricier for the consumer, right? But again, I think that's something to keep an eye on. And what your thoughts are and beliefs on climate change and all that, right? There's arguments on all sides for that. You can't argue that we're in a trend pattern, if you will, where some of these states and some of these areas are just getting, beat up year after year with this natural disaster stuff. So it's going to be real interesting because it wasn't just insurance that he talked about. He's like, you watch, certain lenders are going to start pulling out of these areas because again, they don't want the risk. And I can guarantee you that you might see before they completely pull out that there may not be like low down payment loans and stuff like that. Buyers would have to have more skin in the game because the lenders don't want to be sitting there, on the hook for a 95 loan to value mortgage if the home gets destroyed by a natural disaster. So it'll be interesting to see what happens there. All right, last bit here, lending news. It's that time of year again. Every February brings the Federal Home Loan Bank down payment assistance and grants programs to the market. We're still waiting for our green light date on when these applications can be submitted. It's going to be here towards the end of the month. But the programs and the down payment assistance amounts have been published. So they have what we call set aside programs, which is it's a second trust lien. And they do first time home buyers for 17,500, and that's first time home buyer only, no exceptions. And then they've got $20,000 second lien, 0% interest for community partners. Now, this can be repeat borrowers, but they must be employed in or retired from any of the following professions. That's educators, law enforcement, firefighters, first responders, healthcare workers, and veterans. And again, that's a 0% interest loan forgivable after 5 years. I often get the question, hey, if my buyers do this program, do they have to stay in the house? Well, they don't have, nobody can make them stay in the house. What if, something in the family, life throws them a curveball and they've got to move, or the job transfers them to a different state? A mortgage program in and of itself can't make you stay in a home for 5 years. But if you sell or refinance that, right, they uh, they will require that to be repaid. And what they do is they do that on a prorated basis. So essentially, over the first 5 years, right, if you're there for 2 years, it's going to be 20% proration per year. So you're there 2 years, right, you're going to be prorated have that 40% taken off. Um, Last year, they added the Workforce Housing Plus. And now this is a true grant, 15,000, same amount as last year. And this can be repeat borrowers as well as first-time homebuyers. It's a unique program because so many of the programs out there, the Fannie Mae and Freddie Macs, are for borrowers whose income levels are at or below 80% of the area median income. This one is specifically for 80.01 up to 120. Now, what's not readily published, but I do want to, if you happen to know and you go to the Federal Finance Housing Agency for their AMI, that's not the same. So Federal Home Loan Bank, they have their own income limits that they set. So they have their own 80% AMI that they factor, that they will qualify and disqualify around. But the nice thing about this Workforce Housing Plus is it is a true grant. There is no retention period. There's no prorated payback if somebody sells or refinances before a certain amount of time. So it's kind of a nice place because, again, that 80% or less, yes, those people, the above programs, first-time homebuyer community partners, that's, that's great. It's great for them. That's great assistance, but it was nice to kind of come through and say, hey, we've got this, we have these income earners that are a little bit more than that, but we're not calling them like filthy rich, right? So it's nice that there's a program. Now, the reality of this money, though, as it gets released, the end of February, I want to say last year, I think June or July timeframe, the first time home buyer and the community partner stuff was gone. So it can go pretty quickly. But it's not it's not the it's not always the end. In the summer months, we've seen in the past where the banks, that are participating in the program, Federal Home Loan Bank will issue some more funds, and then there's usually another round of money in the late summer, early fall months to kind of finish out the year. But that's also not a guarantee either. There's a question in the chat there. What is AMI? Area median income is what AMI is. All right. That's a wrap for February. Anybody have any questions?
Oh, one question. What is AMI? Did you mention, did you
Yep.
talk? about that?
I
Okay.
just
Is
answered
home
that.
insurance going up may prevent lender to agree to finance if tariffs come into the picture and prices are up, people losing their government jobs, not very positive for real estate future.
Sounds like it, right? The initial press is home insurance going up, right? That's inflationary. The unknowns surrounding, tariffs what inflation impacts will that have? Again, there's a lot of what ifs and a lot of we just kind of have to wait and see around these. I don't, I don't think it's going to be, well, it doesn't sound positive for real estate. I'm still going to remain optimistic that the real estate market will still churn. And, I try not to get too far ahead of this stuff. because we kind of have to see how some of this stuff is going to play out. Because who knows, it could have little to no impact. Some of these things may not even happen. It's one of those, just wait and see. Anybody else?
Now we're all feeling depressed.
One
Oh, here we go, Patricia. In addition
one of these months, right? We're going to have some really good
Yeah.
news.
in addition to the
And it's-
increasing costs of homeowners insurance is the cost of home maintenance. The cost of any size repairs off the charts. Agreed. You know how much it's going to cost to get my roof replaced? You guys better be sitting down for this one. Now, I do have a 6,500 square foot house, and my second level is bigger than the bottom level. So it's like 3,500. $72,000. I'm glad you're sitting down for that. That also includes some inside drywall work, and also my porch got hit because we get a lot of hail. And we have a pocket of hailstorms for some reason every year. But unbelievable. That didn't even include my gutters. I did my own gutters this time last year. You know,
So my rental property, I had the roof replaced. It's a townhouse, right? That was probably 2010. And I think the total roof replacement was like 3,300.
right?
I just had my roofer out there, and just to replace the little boot that goes over the vent stack and replace the attic fan because the attic fan motor died, and a little bit of caulking here and there, $1,550
Oh, yeah.
just for those three items. And because that was my thing. It's like, oh my gosh, like 10 years ago, right? Or, 12 years ago, whatever. I'm paying I'm paying half of what I paid to replace the roof 12 years ago on these three little
Right.
dinky repairs.
It,
It's
it's, a-
crazy.
it's absolutely right. I
Yeah.
am redoing a house right now. It's like, if I didn't have my regular contractors, I would go bankrupt. I mean, it's literally astronomical, and it's high enough for them, but it really is amazing. And so I had to get some outside estimates for a few things like a sliding glass door, and it's going to be $3,000 to replace that sliding door. It's broken.
Yeah. Patricia, this is great that you bring it up, but in talking to my roofer, now I've got a good rapport with my roofer, so I can joke with him. And I kind of said that. I'm like, oh my God, you're charging me half of what I paid to replace it years ago. And he's like, yeah, it's like, you're darn right I am. He's like, my insurance is through the roof, right? For the business. So it's, and again, who ends up paying for it, right? The client, customer, and consumer.
Right. That's right.
Yeah,
So
good point.
that's why I haven't moved yet, because nobody's doing deferred maintenance. So I get to go buy something at top dollar and then pay $200,000 just to live there on deferred maintenance. So yeah, I mean, I stay in my big house and just take in more cats. Anyway,
Yeah.
which we already have 12 animals. I mean, why not a few more, right? All right. Well, guys, have a great day. Thanks, Mike.
Yeah. We'll see you next month, guys.
All right. Take care. Bye-bye.